From Dubai, we are joined by Arun Leslie John, joining us from Century Financial Chief Market S&P. We have seen the best performance since 1990 for S&P 500 in that month. Do you think the markets are already reconciled with the trade war and the constant change in tariffs?
I think so. The trade war headlines have been hitting the market since the beginning of the year, and so far we are not seeing the worst play out. I mean, from extremely high tariffs, for example, tariffs on China, they have come down to 30 percentage recently. So, at 30 percentage, the market believes that it is kind of manageable. It is not going to disrupt the US economy. It is not going to disrupt the US household. So, I think we might have seen the impact of trade tariffs. The worst might be over. So markets have reconciled to it. Even if we take a look at the Chinese tariffs, uh, China's exports to United States come to about like a $500 billion a year. A 30% tariff on Chinese exports means the additional cost to the US economy will be $150 billion a year. The US economy is near 30 trillion or 30,000 billion dollars. I think the market believes that extra impact on the US economy is manageable.
Aaron, do you believe that yields on bonds, treasuries, are still at risk for markets, especially that they haven't dropped clearly from the high levels they have reached?
They have not. When we take a look at the yields, it is not just the US yields which are staying at a high level. In fact, the long term bond yields across a large number of geographies is staying high. In fact, last week, we saw the Japanese government bond auction for the long tenor having a very low demand. So it is not a US specific issue. Bond investors generally, they are not going for the long term tenure. Now, coming back to the US yields, um, if the yields stay at these current levels, I believe the yields again have not fully reflected the slowdown in inflation. We have already seen the core PC come down, the personal consumption expenditure, which is the preferred gauge for Fed inflation. It has also come down. We have seen the continuing jobless claims also increase. We have seen the mortgage, due to the high mortgage rates, uh, housing prices are coming down, the construction is slowing down. So the long term yields, they have not fully discounted the slowdown in economic activity in parts of the US. So there is limited scope for the US long tenor yields to go up. So I would like to believe that maybe one trigger for the yields to come down in the future might be if the US government decides to shift the issuance of bonds. Like, for example, if rather than issuing a large quantity of long term bonds, if they decide to issue more bonds in the short term spectrum, that might bring down the yields in the near term. In fact, the news flow suggests that there are already some talks in that regard.
Aaron, since we are speaking about bond market, do you believe the factors you mentioned related to the economy, inflation, and jobs will have a bigger impact on yields, or is it the fears of the deficit and the Trump tax package?
The deficit and the Trump tax package, I guess, is having more of an impact on the US bond market than the trade tariffs. Now, uh, the deficit For example, an increasing deficit can lead to larger issuance of bonds over the next few years. The tax cut in particular can lead to lower revenues. So, I mean, this is especially in a period where the central bank has shifted away. During um, in fact, the central bank, the U.S. Federal Reserve, is actually cutting down on the purchase of bonds. We are seeing a reduction in the balance sheet size of central bank. I think from a peak of $9 trillion, the U.S. central bank balance sheet has come down to about I think near 7.8, $7.9 trillion. So the rise in deficit or rise in bond issuance from the US government is coming along with a reduction in liquidity of the system. So that is, I think, more troublesome for the bond market rather than the trade tariffs.
From Dubai, Arun Leslie John, you are joined us from Century Financial, Chief Market Analyst. Thank you so much for having joined us today.
Thanks a lot. Welcome.